Let's bring in the aforementioned Paul Sankey of Sankey Research. Paul, thanks for joining us, especially on pretty short notice. You know, I kind of threw cold water on that reporting initially. It looks like that's sort of the correct way, but this is out there. What's your take on all of this?
Well, Brian, to use the soccer term or football term, I think Bernard Looney got a yellow card and then a red card, in fact. But the strategy was definitely a huge error in 2020. And of course, they then had the opportunity to change completely with a new CEO. And they went with a continuation candidate to really continue this erroneous strategy of trying to make an oil company into a renewable company as two very, very different costs of capital. And they should never have gone near to it. Additionally, as you know, and you mentioned Macondo, there's been issues of safety and operational integrity over the years. And finally, the old line that a camel is a horse designed by a committee is standing on BP, which is to say it's a camel of an oil stock. You know, it's a whole mix of stuff. BPX is a big US E&P. They've got a huge refinery in the US. You have Azerbaijan in there. You've got Trinidad LNG. You name it, there's something there. And particularly knotty is the huge trading operation where BP is genuinely best in class, or right up there, actually, with Shell. And that would be a very tricky thing to combine and a very tricky thing to split up. But the fact of the matter is that BP is so cheap now, it's trading at such low cash flow multiples that the breakup story that you're promoting, I think, is the right way to look at it. And I think that the combination of Shell and ADNOC from Abu Dhabi is another, sounds like a plan type idea. But of course, as you highlighted as well, Wales at Shell is saying we don't need to do it.
But let's go back now to our other developing story. That is the oil story, Paul Sankey. I have no idea what we just talked about with the Fed, but let's go back to oil and gas because that's a little bit more my speed. I'll leave that to the smart people like Leslie and Kelly to figure that one out. I had another person today, a source, tell me that they thought that ADNOC, which is the Abu Dhabi National Oil Company, could also be a potential buyer for part of BP. By the way, they just did a big deal for an Australian company that's big in Alaska. Am I hearing you right in that you're kind of suggesting that BP is, I don't want to say too big to succeed, but certainly maybe too varied to succeed?
Yeah, and I don't think it helps that it's quoted in London. The UK government, I think, has done a horrible job of oil and gas and has now the highest electricity prices in the OECD in the UK, which is terrible. And so, whether or not BP would be defended by the UK government is debatable. They themselves have a windfall tax on the oils through 2030, which is really crushing the North Sea. But yes, it is a complicated breakup, notwithstanding as well the UK government. But having said that, what you're seeing, and you just mentioned ADNOC buying into Santos in Australia. You've got Mitsubishi coming in here to the US E&P story. These assets are highly undervalued, not only at $80 oil, which we just saw, but also at $50 oil. You're talking about extreme low valuations here on the totality of BP, and the pieces almost undoubtedly would trade at a much higher multiple if they were broken up.
Paul, for a non-specialist, what can you buy in the energy space right now, and feel like, okay, maybe there's going to be further consolidation play? I don't know if it's a target or what else might happen. Do you think the BP case, like Brian was saying earlier, is kind of unique, or could there be more to come?
Well, I've got this sort of Benjamin Graham, very noble value argument for the oils, which is that I do think that the equities are fundamentally undervalued against the future free cash flows they'll generate, high cash return. And that the managements and strategies are much, much better. BP is a major underperformer, partly because the Exxons, Chevrons of the world, Conocos are in great shape. One theme here, I think, for you guys is there could be much more mega M&A, particularly during the Trump administration, because the way for these guys to get people excited is definitely to get bigger and cut costs, or break up and sell assets. So, I think it's an important story and we'll be watching it. And I think that oil in the market, oil and gas, especially in the context of AI and energy demand, is badly undervalued at the moment.
And also the trading side, right? We never talk about that, Paul. It's not just putting a pipe in the ground and taking out oil or gas, but it's that you've got Shell has, I think, the world's biggest and maybe the most profitable energy trading business out there. BP does well, but it's kind of lost in the shuffle, right? It's hard to know what's valuable inside of BP.
Yeah, and it's lost in the financials as well. The market chatter was that BP made $10 billion trading in 2022. And yeah, these are highly valuable companies, very volatile businesses, which is what makes them so hard to value. Additionally, they somewhat depend on a big asset base. So, you can't break out a trading unit you'll see the Glencores of the world, which is really what we're talking about, have major assets in order to help their trading. And that becomes another complication around the best way to break up BP. But you're right, Shell also has an outstanding trading operation, and it's volatile, but it makes a ton of money in the volatile years, such as the past month.